Well, fast money fans everywhere knew to expect this market rally come with the end of the month because our next guest called it a week ago right here on this show.
We're buying this dip. So if you look at the last 4 days, what has happened is we have transitioned in the markets from uncertainty to fear, okay? And all of us sitting around this table know that if you look at the last 30 years, every time you buy fear, it works out, okay? We don't think it's different this time.
We are joined once again by Julian Emanuel of BTIG. Julian, great to have you back.
Great to be here.
Was that it?
Perhaps. When the market is as volatile as this is, declaring is that it with capitals is never really the right thing to do. It is a process. Volatility, as we observed, VIX is still well above 20, which means there's lots of surprises. But today was encouraging. Would we have liked to have seen the market close near the highs today? Absolutely. But there were three things about today. First of all, 27.11 in our mind was a very key number because actually you've had explosive negative readings in the intraday volume on both of those days where you touched those numbers at the low and the high. But really, as well, the other thing for us is on a day like today, there were still lots of buyers of puts. And that almost never happens when you have as strong an up day as you had today. So for us, that's the kind of hedging, that's the kind of residual fear that's still out there that we think once the uncertainty of the election rolls by, however it sorts itself out, that closing of those hedges is going to fuel further upside.
Did you like what helped the rally in today's session and in yesterday's session for that matter? We had that pullback that Karen mentioned in retailers, in home builders, for instance. We had strength in financials, strength once again in tech and communication services. Is that the kind of snapback rally you want to see? Very
much so. And okay. the other thing that really made us happy today, when you see one of the world's marquee automakers up 9% on incrementally good news, it tells you that, those are names that are heavily shorted. Those are names that are essentially discounting a large slowdown next year, if not an outright recession, trading better because the economy just isn't there yet. We're still on decent footing.
Hey. I was just going to say real quickly, Julian, because you mentioned GM and we talk about housing. I mean, these stocks are still down considerably from their 52-week highs. So what is the thing that would catalyze them? Do you see a reacceleration in growth here in the U.S. or globally that can take these groups that have been laggards back up?
Well, we have to go back to the two 800-pound gorillas in the room that are going to be with us probably for months. Number one, trade. You have to have some progress in China. Tim mentioned this before. If you don't have progress there, 2019 could be a challenge. The other thing is, again, the Fed. We've talked about this quite a bit. We think the Fed is on the cusp of making a policy mistake. We'd like to see them, at minimum, if they're going to hike in December, think about signaling a dovish hike because, quite frankly, the risks of an escalating trade war, if you fix it, there's upside to beyond 3,000. If it escalates, 25% tariffs and further acrimony next year, you could trade back down to 22, 2,300 very quickly. That's the kind of risk, it's a very large risk reward.
So the Fed hikes rates in December and signals more hikes in 2019 definitively, and you say the market goes down on that.
That's likely a negative, yes. Absolutely.
But the positive forces in the market right now are enough to bring the S&P 500 to 3,000?
We think so. We think so.
You're painting the Fed in a box then, because you're saying that everything lines up, right, for S&P 3,000, which would be positive, positive, positive. But then you're saying, well, but the Fed has to be dovish.
Or with what leadership, Julian? I guess that's what concerns me, because it seems to me that the technicals have broken down for triple Qs, and certainly for everybody other than Apple. Where's the leadership coming from?
It's going to have to come from the more value-oriented sectors and stocks, the industrials, the banks, energy, all of these things that, when we look at it, have worked on the short side this year are really where the profits of short side traders lie. And those things, particularly when you think about energy, at 6% of the way to the S&P, at $65 to the barrel of oil versus an historical weight of 10%, there's lots of room for upside there, particularly when you're going to get Iran sanctions renewed next week.
All right. Julian, thank you. Good to see you. Julian Emanuel of BTIG. Pete, what do you think?
Well, I actually did for a trade the other day on Monday. I don't know if you saw this, Dan. You might have even put it out on the show. I don't know. But the triple Qs, we saw some huge buying at the very end of the day on Monday. I'm already out of that trade because I don't believe what I'm seeing in front of me because of the volatility of what we're seeing in the markets. I mean, volatility is volatile. I mean, when you see volatility,
rally, basically.
Well, yeah. I mean, it's not even necessarily faded. I just think you got to trade it because at any moment I could see very easily. I agree with Julian. 3,000? Yeah, maybe under the right circumstances, maybe. But otherwise, there are plenty of headwinds out there that actually could push us down, whether it be the Fed or trade talks or the midterms, all those different things.
It's really important to go back to what he said. You know, what gets us back there? What's the catalyst? You know, when you got to separate the markets and then what's the thing that the economy is going to happen there that's going to catalyze those stocks to come back? And I just don't see it right now, given all the uncertainty. The thought that we are going to get any clarity on all of these issues that we think are headwinds that we just detailed in the next couple of months to get the markets to 3,000 just doesn't make any sense to me right now.
The magically reappearing Julian can probably answer
he's
this.
back. Oh, hey. Wow. I thought I could buy the guest, but I guess that doesn't stand today. Anyway.
I actually faded just a little bit of my GM position today because I look at the charts and I think actually having rallied about 14-15% off the lows very, very quickly, and I realize we have fresh numbers. I love GM. I'm being a trader on this one, but GM, banks, industrials rallied early cycle. There's a strong argument we're late cycle. Why will they take the leadership now?
Because this cycle is quite different in that you had such a disparity between growth and value that even if this isn't a secular shift back towards value, the valuation disparities, the price gain disparities, which is, again, part of the angst as to why, people are looking at FANG and saying they're broken, et cetera, et cetera. And when you look at a stock like the world's biggest mobile phone maker who's going to report tomorrow, it's only trading at 15, 16, 17 times. That stock's different from the rest of the group. That stock's less sensitive to a Fed who's hiking. So it doesn't necessarily have to be in an environment where correlations are lower. It doesn't have to be all tech.
Yeah, but it's not less sensitive to slower global growth, and it's not less sensitive to a brewing trade war, because ultimately Apple's going to be the last battle fought in a trade war, and ultimately we will see some considerable damage done to their supply chain and possibly tariffs for their phones coming back in here.
It's a very fair point, and when you look at the last several weeks' action in the market, my suspicion is that Washington is getting that message.
Julian, once again.
Magic. It's like,
joining us.
It is home.
Great to see
So there's
you
some
again.
magic in the air.
Double.